Welcome back, everybody, to VTS Options. So today I'm going to be breaking down what is a staple in my own option trading toolbox, the long put vertical. Among the four variations of vertical spreads, both puts and calls, and then long and short for both of them, this long put vertical is the one that I trade most often. Now, it has many applications. This is definitely a trade people want to get familiar with. But it also has a very specific application, which I'll get into with a real example of how I apply this trade to the Volatility ETP called UVXY. So subscribe to the channel, hit the like button for me, and after you watch the video, definitely go check out my website. There's a free newsletter on there, so you can get sent regular options and volatility content directly to you. But with that, let's get into the long put vertical. Now, the long put vertical is comprised of buying both a long put option and then selling a short put option further out of the money against it. And doing this does cap both the gains and the losses. I'll get into the UVXY trade example in a minute. But first, here's what all long put verticals look like. If we go through a quick hypothetical example here, it'll be pretty easy to understand. So we've got stock XYZ currently trading at $60, and we're going to buy a 60-50 put vertical. So that's a long $60 put, and then a short $50 further out of the money put. Like I said, it's done in a single transaction as a spread, but doing this caps both the maximum gain and the maximum loss, turning this into a very effective trade with good risk management already built into it. Mainly this trade is just about position sizing. But looking at that maximum loss, that's calculated simply by multiplying the premium paid for the contract by 100, because each one contract represents 100 shares of the underlying. In this case, we paid $5 for the trade, so the maximum loss, no matter what happens to the underlying, is $500. And for the same reason, the max gain is capped as well. That's calculated by taking the difference in the strike prices, so $10 in this case, and subtracting the premium paid, which was $5, and then again multiply by 100. That means the maximum gain is $500 as well. No matter what happens to this trade, we know ahead of time what the maximum gain and the maximum loss is, and we can manage risk accordingly. Now, that pink line there is called the daily profit curve, and I'll get into how that's used when I dive into my trading software. But first, we have to talk about the three main option Greeks affecting this trade. The Greeks are statistical values that provide us a way to measure the sensitivity of an option's value with respect to other factors. There's many of these, but we really only care about three of them. Delta is an option sensitivity to price. Long put verticals are delta negative, meaning they profit from decreases in the price of the underlying. Whatever we're trading here, it's a bearish trade and we want the price to go down, so it's delta negative. Theta is an option sensitivity to time. Long put verticals are theta negative, meaning time will eat away at the value of the contract, so we do want the move to happen relatively soon. And lastly, Vega is an option sensitivity to volatility. Long put verticals are Vega positive, meaning they benefit from increases in volatility. So we typically do like to open these when volatility is already pretty low, just allowing for a little bit of room for it to increase. So now I want to get into a real trade example, and like I said, there's many applications for this trade. Stocks, bonds, gold, basically whatever you think is going to go down in price, this trade can be appropriate. But there's that one specific underline that I very often apply this trade to, which I want to show you an example for now. So this is the Thinkorswim platform from TD Ameritrade, and this rather ugly chart that we're looking at is for a volatility ETP called UVXY. So without boring you too much, as the VIX futures naturally decay in the long run as they approach expiration, this product, which tracks the front 2-month VIX futures, it tends to trend downwards in the long run. Now this is a 1-year chart, but we can easily back up to 5-year time frame, and you can see more or less the same thing going on. Now on first glance, it might appear that the best trade might be to just short it, but actually these occasional spikes that you see, they can actually be quite violent. I have several videos talking about the dangers of shorting volatility ETPs directly. And if you zoom in, it's really not hard to see why. This is in February 2018, but this is going from a low of 42.60 all the way up to a high of over 150. So if a person were short the shares, a 200 to 300% spike could be a real problem. And remember, that's really only during a very short-term blip. If we do have an all-out recession, anybody who's short this thing directly is going to get their account blown up. So we have to figure out a better way to do this, and long put verticals are a very good trade for this type of product. Go back to a 1-year chart for a second here, and I'll show you what I mean. So all of these red hash marks, these are option expiration cycles. And you can see that just over time, it does tend to trend downward. Again, it spikes up violently very quickly, and if something like a flash crash were to happen, it could be a nightmare for anyone short. But in general, we do want to profit from the long-term decay of this product. Now, I have other videos that go into this in more detail, but just as a side note, it's not a good idea to do this on a regular time schedule. So sometimes you see people just doing weekly contracts or just doing one of these every single month. But there's no edge in that strategy. All traders already know that this product decays over time. So anything done on a time schedule is just not going to work. The premiums already price in the long-term trend of this product. So for me personally, I track a massive amount of volatility data every single day. And with this, I determine the best times to actually initiate these trades, and also when the risk metrics are flashing warning signs, and it's best to just stay in cash and wait for a better entry point. But for today's example, assuming all of my risk metrics here give me the green light to actually initiate a trade, that's what I want to show you what it looks like. So I'm going to go over to this Analyze tab, and we're going to pick a monthly expiration here. I tend to go a month out, maybe a little longer, so this February, expiring in 40 days, this is going to be a good one. Now in Thinkorswim, calls are on the left, puts are on the right. We're doing a long put vertical, so we're going to focus on the right side of this screen. Currently the markets are closed, but at last close it was at 11:59. So I'm just going to do a basic at-the-money long put vertical. We're going to buy to open a vertical. And this is what that looks like. You can see it was opened as a spread, one single transaction, but it's comprised of a long $12 put option and then a short $11 put option. And this is that familiar shape for all long put verticals. So here's today's price right there, right about at the money. Because we're doing both a long and a short, it caps the gains and the losses. So now we can take positions in something that we can't short outright, but we can actually take short positions through this type of option spread. So a few things to highlight really quick. First of all, this max loss over here, this is just the premium paid multiplied by the options factor of 100, because one contract equals 100 shares of the underlying. So 56 cents times 100, you can see the max loss is $56. No matter what happens, if we see one of those massive spikes, if a flash crash happens, under no circumstances could you lose more than $56 per contract. And for the same reason, the max gain is capped as well. To calculate this, you just take the difference of these strikes. So 12 minus 11, that's a $1 strike gap. And then you subtract the premium that we paid for the contract, which is 56 cents. Multiply that by 100, and we can see the maximum gain is $44 per contract. So this particular trade is fairly evenly balanced here, can lose slightly more than you can make. But remember, this trade is all about finding the good entry points and then just repeating it over and over to actually start developing a longer term rate of return. So this trade has already very good risk management built in. It's just about position sizing. But I do want to highlight this pink line, which is the daily profit curve. Now, some people might want to just put these trades on and let them expire. And you can definitely do that. You just have to pay attention around expiration to see if you're going to be assigned anything. But what I often do is actually use a stop loss and a stop gain. So just as a quick example, a 50% stop loss and a 50% stop gain, that would be based on the premium. So half of that is 28 cents. If this trade was down more than $28, I would consider closing it. And you can just take these hash lines and you can just mark where that is. So I can actually extend this a little bit. I can find that down 28 and I can just put the hash line there. And then the same on the upside, I can just find that $28, let's say right about there. And I can now watch my trade develop based on this daily profit line. When I hit either one of those hash marks, I'll know it's time to close it. When you use stop losses in this case, when it's equal on both sides, then you no longer care if the trade is balanced. Sometimes you can lose twice as much as you can gain on the expiration, but if you use a 50-50 stop, then it really doesn't matter what the expiration prices look like. This turquoise line becomes irrelevant, and we just focus on how the price is developing along that pink line. So that's how I tend to use this trade. But we'll do the Greeks really quick. They are important. First of all, delta. We can see at today's price, it's a negative number. This is a delta negative trade. That means it's bearish, and of course that makes sense. We do want the price to go down. UVXY is at about $12 right now. We want it to go this direction to start making our profit. It's a bearish trade. The second Greek is theta. And again, this is a negative number. That doesn't seem like much, 0.09, but that is a daily decay and it will add up over time. Remember, this contract has 40 days, so the negative theta will eat away at the contract. You can see it in the price here. If the trade just hangs out in this range, then we can actually start losing some money as it goes down to that price. So anything at the money or out of the money, you do have to pay attention to that theta decay. And the last Greek, we have Vega. Can see here, that is a Vega positive trade. Now, of course, because we are buying and selling a contract here, the gap in volatility between them isn't overly high. So this trade really isn't about Vega. It matters a little bit, and sometimes with higher volatility, you may decide to sell a short call vertical, but honestly, it doesn't make much difference. This is basically a delta trade. We're looking for the price to go down. But that's pretty much it. Remember, long put verticals are appropriate anytime you think something is going to go down in value. And since the long-term trend of volatility ETPs is down, minus a few violent spikes to the upside, this is a trade that seems to be tailor-fit for this purpose. I use it all the time. I call this my vol step strategy, and within the VTS options community, we trade these things all the time. Again, the only time I'm really not doing that is when my volatility metrics are saying it's better to be in cash. Now, if all of this data does look a little bit daunting, don't worry about it. Within the VTS community, I explain what all of this stuff means. And it's very useful for volatility trading, but also just for trading stocks, bonds, gold, whatever the underlying is. So for me, that is a very common way that I apply this trade. But let me review those main points. These are delta negative trades. So whatever we're trading, stocks, bonds, indexes, ETFs, we do want those prices to go down. And like I said, with the UVXY, that is very common, the path that it takes. Now, these are theta negative trades as well, meaning time is working against the trader. Whatever move we're expecting, it is better that it happens sooner rather than later. Long put verticals are Vega positive, meaning that increases in volatility are advantageous here. Now, UVXY is a specific case, but whenever I'm trading something else, like stocks and bonds, for example, I do want that starting point of volatility to be reasonably low, just allowing for a little bit of risk buffer there. And lastly, these are both limited gain and limited loss trades. So risk management is pretty straightforward, and it really just comes down to position sizing. So whether you use this trade on UVXY like I often do, or just on regular stocks and ETFs, it's definitely a trade that you want to make part of your regular arsenal. So don't forget to sign up for my newsletter and join the VTS community whenever you're ready. Thanks for watching. So if you're interested in options trading, go claim your free 2-week trial on my website. In that time frame, you'll definitely see a wide variety of trade types: iron condors, strangles, calendars, earnings plays, pairs trading. I have many profitable strategies that you'll be interested in. Come join the VTS community.